Welcome to the Elevate Market Chat. This episode was recorded February 20th, 2026. In this episode, Shane and I dive into the market themes emerging for 2026. Emerging markets, represented by the EEM ETF, have delivered solid gains amid a shifting landscape. Will this be just a flash in the pan or the start of a bigger rotation? Shane and I break it all down. We unpack emerging markets and why they outperformed expectations last year, spotlighting the weakening US dollar in that classic risk-on mood, and zoom in on the technicals. We also tackle sector rotations, including a skeptical take on the energy rally and the Venezuela headlines, before turning to the bigger picture, including Mag 7 and top 10 dominance, and whether it's showing signs of fatiguing in 2026. Thanks for tuning in. Shane, how's it going?
Hey man, it's going well. I've got some Olympic hockey on the screen. Canada just tied it up 2-2 with Finland in the semifinal game, so I'm happy. I like hockey, and there's lots of good hockey to watch here the next few days.
That's awesome. And
the women won the gold last night. So Team USA women gold in hockey, very nice.
That is great. And how does it look for the USA men's team?
They're looking pretty good. Canada looks really good too. But they could go any way. I mean, we all remember 1980. So the best team in the tournament can and has lost before. So I don't think anything's a foregone conclusion here. These are some great hockey teams that are left, and I think it's up for grabs. But the Team USA's looked really good. They've looked really good.
That's great. So that's on the heels of I don't remember the name because I just haven't been following it as closely, but for women's figure skating, US took the gold there. So that was the big news that I saw hitting the feeds this morning.
I haven't watched Olympic figure skating since Nancy Kerrigan and Tanya Harding, man. I don't. That's the only thing I know about figure skating.
I don't think there could be clear evidence about when we were born and what generation we grew up in. So
that's funny.
That still sticks with me. So, but I know we're here to talk about markets, and today is Friday, February 20th, and I'll start off big picture what we're seeing year to date across the indices, SPX, NASDAQ, Dow, pretty much unchanged for the year. I think, finishing strong into the second half of last year, a break is totally expected. But then the big one here, and I'm going to ask you about this one, EEM, that's an ETF, represents emerging markets. That is up almost 12% year to date. So that's a pretty strong run there. So with that, I'll kind of just turn over. We can talk about the index and maybe some pockets in that index. But, the first one is emerging markets. How do you view that? I know I showed you a chart and we can talk about that, but, fundamentally, is there something there behind that strength?
Yeah, I think it's really mostly a function of the weaker dollar and a risk-on sentiment. Certainly there has been lots of talk over the past, I don't know, 9, 10 months, year about, a flight from the US due to the tariffs that were imposed by Trump and just got struck down this morning by the Supreme Court. So we're dealing with all that today. But I think a lot of international markets have looked better economically. And with the tariff situation being what it is, I think people all around the world have kind of said, hey, how much exposure do we really want to the United States in this type of a regime? You look at our debt, our debt to GDP, our budget deficit we're running, the $38 trillion plus that we have in national debt, which will probably finish the year, over 40 trillion. I think there's a number of different reasons, but I think the main driver, and this is not set in stone, but I think the lower dollar certainly gives a tailwind to the emerging markets, particularly in emerging markets that are set up for GDP growing faster than in the United States and inflation being at least manageable in those countries. So there's a number of things that go into global economics and what might drive the emerging markets. But they've spiked like this before and kind of failed to really over the years I mean, I think in that chart you showed me, right? If you had bought emerging markets, what, 5 years ago, right, at any of the peaks over the past, say, 5 or 10 years, you'd be about flat today, maybe up a little bit, because I think it was breaking out a little. Maybe you can correct me if I'm wrong. I've seen a lot of charts today, so maybe I'm thinking of the wrong one. So from that perspective, if you bought every one of the peaks, your money would probably be dead over the past 10, 15, 20 years. But if you bought at all of the lows, then you'd be up nicely today, riding it through some volatility. So, it's hard to say for me. When you get into global economics, there are just so many intricate relationships. That's why you always got the several-handed economist, where it's like on one hand, on the other hand, on the other hand, on the other hand. So I could make an argument all day for the fundamentals of many emerging markets. And another thing I think that's happened over the past several years is the emerging markets funds have, I think, cut Russia out of their exposure altogether. And don't quote me on that because I've literally done no research at all. I'm just talking about it on the fly. So, like, I know that what used to be the BRICS ETF, the Brazil, Russia, India, China, is now called the BIC. So they just took the R out completely because I think, I don't know what's going on with Russia's market, but it's very difficult in the United States to buy anything Russian ever since they started the war with Ukraine. So that might be a net positive overall for the emerging markets funds. But Kyle, as you know, and I think you lean on pretty hard. I mean, technical analysis says that it's breaking out, and so the question can it sustain that momentum and break out into a new trading range that is above and better than what we've seen over the past decade or more? So, perhaps that is a good place to be. And I was telling you that we actually bought some emerging markets in our momentum strategy in June of last year. And the only difference between the ticker symbol you mentioned and the one that I chose is that mine's leveraged. So it's EET is the ProShares Ultra emerging markets ETF. So it's just a leveraged version of the one that you mentioned. And year to date, it's up. What would you say the EEM was up?
11.6 when the market's opened.
Yeah, EET is up 25.83% as we're talking today. So I like now you can do two different things with that, right? Like leveraged funds can get you in trouble or they can free up your portfolio. And what I mean by that is if I'm in a two times levered fund, right? Which means it goes up 2% for every 1% the regular fund goes up. Let's say I was going to put $10,000 in EEM because I want $10,000 of EEM exposure. Well, I could put all $10,000 in EET and get double the upside and double the downside if I'm wrong, or I could get the same net return by only putting $5,000 into EET. So it allows you to capture the same amount of upside with half the dollars if you do it right. If you do it wrong, you can be taking a lot more risk by buying the leveraged fund. So that's how I like to think about these leveraged funds sometimes is you buy half as much as you were going to, or in a three leveraged fund, you buy a third of what you were going to. And that frees up a lot of other capital in your portfolio to do things that would diversify or give you some type of hedged exposure.
Yeah, that's a good way to look at it. So for somebody looking to free up a little capital, it's a great way to go. One thing just back to the chart that I wanted to point out. So I showed you a chart and it was a monthly chart. So, very big time frame. And we did have a couple other rallies that did fail. So 2020 was one period where people may have been talking about it like we are now, getting very hyped up, and it failed. And if you bought then, you would have just been sideways and down quite a bit up until this point. Now, one thing that's interesting, and it was going to be the first mention, I just didn't get around to it, was it looks a lot like the US or the S&P 500 on the same type of time frame. So long-term, monthly. And if you look at the rally you had in the dot-com era, so 2000, and then the rally we had in 2007, it looked very similar to that, and then it broke out. Now, weathering those periods would be very hard. Excuse me, as we noticed for any of those that were over leveraged or over risked during those time periods. But if you really go big picture, that was a great breakout as we saw. Now, emerging
Yeah.
markets looks like that, but it's only a chart. It doesn't predict anything. It helps you maybe tilt the odds in your favor. So we'll see what happens, but it's interesting. It's been a pretty good move and good start to the year.
Yeah, what's always tripped me out about emerging markets is when will they cease to be emerging? That's they've always been emerging, and it's always been China as the major part of the basket or Brazil. And it's like when will these countries finally have emerged? And despite all of my studies, I've never found a real good answer for what in the world would ever cause China to no longer be in an emerging market. I mean, it seems like they have a pretty well established economy at this point, Brazil as well, and many of the others. But like, at what point are they no longer emerging and they're actually a developed market? And I'm sure that has to do with demographics and size of the economy and all those types of things. But nobody's ever given me a definitive answer. And I mean, I don't know. It's just kind of funny thing to think about. Like someday, 100 years from now, when all of the economies of the world are run by AI and everybody's on universal basic income, like will there be any emerging markets left? Will that cease to be an asset class because all economies around the world have finally emerged and we're all developed? And those are just fun things to think about. I don't I don't know that it has any implications to trading or investing today, but I've always thought that was funny. And I have a guy that one of the traders I know and talk to every day. He's always laughing. He's like, when the emerging markets salesman shows up at your office, just kick him out and close the door because they always have the same story and it always seems to fail. But that being said, momentum is what it is, man. And we've been in this trade since, like I said, since June for our momentum strategy. And gosh, EET since we bought it. And this is obviously not a recommendation. We don't give recommendations on this podcast, but we bought it at just under $60, and now it's 101. So we're up 69.2% in 9 months. So despite the fact that I think emerging markets are kind of a fundamental joke, you can make money in them if you buy them at the right time and you just hold on while there's upward momentum.
Yeah. And Shane, you brought up one really good point, and it's kind of funny. I didn't even give you a heads up on it, but I'm sitting here and I have the top holdings pulled up for the EEM ETF. And the number one holding, which makes up 13% of the weight, which just to give you an idea how big that is, the next largest holding is 5.2%. So materially weighted towards that. And it's Taiwan Semiconductor.
Oh, there
So
you go.
TSM. So the funny thing there is that one, if we're talking the AI trade, oddly enough, now here we are again with a ETF that's overweight, something that's probably AI related. And then the other one is TSM. I mean, I could go buy that on a US exchange, no problem. So then the question kind of goes into if you're buying something that's, quote unquote emerging market, is it really emerging market? You'll oftentimes see too where if you have a diversified portfolio and let's just say Coca-Cola is one of those, well, they have the outside US portion of their revenue, which it seems like sometimes that shows up as an actual weighting for emerging market exposure. If you look at your broad basket holding, Shane, is that kind of the proper way of explaining that one?
Yeah, I think so. I mean, think about Coca-Cola. They do business in, I don't know, 200 plus countries around the world. That includes all of the emerging markets. So how much of their revenue comes from emerging markets? It's probably meaningful as a group, right? But any one individual country is probably like not that big.
hmm So, yeah, it's interesting. Various ways you can get emerging market exposure for sure. And it is hard, like you said, Shane. My entire career where I've ever looked at markets has had that same story, and it's always been emerging markets, which is kind of funny because, like you say, at what point do they graduate and become
Yeah,
adult markets?
right. Right. Yeah, I'm just looking at it. So yeah, heavy China. I don't see any Russia on the list and the geographic breakdown. So China, Taiwan, India, Korea. Brazil, South Africa. There's one that says other. Maybe there's some Russia in there, but I think they've eliminated. I think Russia is just kind of isolated from everything at this point.
Yeah. And I think part of that gets into that idea that if a country is somewhat hostile, they could just say, hey, you actually don't own $1 million of shares of this company. I'm sorry.
Yep. Right. Yep.
So,
Which Russia has done plenty of times before to
yeah.
their
But
oil. What do they call them? Oligarchs or something?
yeah. So then, just to round out some of those top holdings, I'll just share a couple other names, but Samsung Electronics, again, most of us know that name. 10 Cent Holdings, I'm not as familiar, but I know that's been on many headlines. And then the last one is Alibaba, which again, we all know the name. So it's not as emerging as it might lead you to believe.
Yep. Makes sense.
But, turning it back to the US here, I did bring up some, I guess, sectors as I usually do. I'm seeing strength just right now. If we're looking at normal time periods, how are these sectors holding up on the short term averages as well as long term? And the strong ones right now are industrials, energy, real estate. Real estate has me a little puzzled on that one. And then on the sector weakness, information technology and communication services. And tech, we'll talk about that one a little bit here because that last year and many years prior has been the absolute leader. So, is that a long term shift, short term shift? What are your kind of thoughts when I bring up those, some of the strong ones or the weak ones? Anything material or long lasting?
Yeah, I obviously would have attention most of the oil and gas stocks. I think they're up on total nonsense of this Venezuela, the abduction of Maduro, and now we're going to open up Venezuela for oil drilling and like I think that is what has driven a lot of these oil stocks higher recently. I think I can't prove it, but I think that's really the catalyst. And I just think it's nonsense. I mean, if you listen to what the CEO of ExxonMobil says about, how long it's going to take to do anything there and whether or not it's worth, is the juice worth the squeeze for a company like ExxonMobil, which, has just gone up relentlessly since the beginning of the year. I mean, ExxonMobil's up 27% this year. And I just don't think Venezuela has any meaningful impact on what their business is going to look like over the next year or two or even three, maybe even 10. If you listen to the CEO over there. So, I mean, there's a guy called Harold Ham. You ever heard that name?
I have.
Yeah, he's the like the guru. I think he founded Continental Resources, and I don't know. He's like shutting down drilling operations in one of the most productive shale areas of the country up in North Dakota because at $60 a barrel, it can't make any money. So how, I think it's kind of weird that I don't know the timing of the Venezuela thing and the ramp of the oil markets. I don't know. It's too to be coincidence in my opinion. But I'm not an oil and gas expert by any stretch of the imagination, so I could be totally wrong here. But I just oh I don't I think that it's going up for the wrong reasons. I think it's gone up too far too fast, and is probably due for a pullback unless oil can keep climbing. Which if you look at the oil chart, it has finally broken out of a little bit of a downtrend that it's been in for what since just after COVID, I guess, when oil spiked to 130 a barrel in what's that 2022 maybe. Um, so I don't know if this will be a lasting breakout. I mean, crude oil is back above the 50-day moving average, but still below the declining 200-day moving average. I think most companies need around 65, $70 a barrel to kind of break even. And we're at 66.38 right now. And you've got some tension with Iran and Trump giving them 10 to 15 days to work out a nuclear deal or get bombed. So that might send oil higher, but only in a spike. Usually those don't sustain. Um, Oil has spiked. The last time that we bombed Iran, I think, what is this, like the third time we've started a war with Iran in a year or something like that? I don't know. But whether it has any staying power, I can't tell you. But if oil is going to rise, then sure, there's a good fundamental reason for these oil and gas stocks to continue rising. Um, Obviously, all the energy usage of AI companies and data centers is a factor there. But last I checked, they're not burning crude oil to run data centers. Um, that's more gas related and hopefully more nuclear related in the not too distant future. Um, so I'm skeptical of the massive spike in XLE, the energy sector, to start the year. But hey, I've been skeptical of spikes before that just turned into relentless momentum for way longer than I thought was realistic. So if this is all based on Venezuela, I think it's destined to fail. But if there's some other, more fundamental drivers that are going to be with us for the long term, then, right now is probably not a bad place to jump on that train.
Yeah. And it's interesting, we talk about the energy sector and we go to crude, and that is a market on its own and requires a whole other level of understanding for how that whole market works. So for me to give some sort of, professional opinion on that is challenging. But when I look at XLE as a sector, that's when it's kind of interesting. So similar to what I was talking about, that high time frame analysis where we really zoom out. XLE had a heck of a run up in '07 and then just got absolutely gutted. And then it happened in 2015, and then same outcome there. Rallied back up, so there's that third attempt where now it has broken to new all-time highs. So on a very big time frame, it does look good on the chart. But one thing's pretty clear with this is that there's been volatility. So if you get in, it may not just be a smooth trend higher. So we'll see how it all pans out. But that's what I see. And again, this is very high time frame. So this is years in the making. Anything can happen within a year, a month. So whenever looking at opportunities like this, it's always important to understand how volatile that particular market or investment could be.
Yeah, man, I'm looking at a weekly chart, and if you had bought XLE on June 6th of 2022, you would have been flat for 188 weeks until the first week of this year.
Yeah.
And here's the thing. If you bought then, you're not up very much. Your annualized return over the past, 4+ years is about 4 years is like 4% a year. But we've owned XLE in our portfolios, well, some of our client accounts, and this is going back to the Elevate strategy or the capital strategy days. We bought it in 2021, in March of 2021, and since then, I'm just looking at some numbers. It's up 80% with dividend, which annualized return of 18.95% per year. So that's just if you're not buying a trending momentum investment, right? And you're not just buying it for the fact that it's going up, the price you pay is the primary factor of what your return's going to be. So you got to buy it when it's at a fair price, and then you can more easily ride out volatility or 4-year long flat markets, right? Because we never stopped out of our XLE position. So there was no, it wasn't going down, it just wasn't going up. And, rather than sell it and look for something else that was going up, we've just kind of held it for a lot of people for a long time. And, those people have experienced a pretty good annualized rate of return. Of course, that could all turn around tomorrow and it could go down. Um, and we'd give back a lot of that return. But as of right now, it looks pretty good.
Yeah. And you bring up a great point. So that is the danger of looking at your portfolio every day is that XLE was great. Unfortunately, you had over a year of just nothing. So is it worth looking at it every day and then bailing during that, year long period of nothing? to chase something else. And now look what you just missed. Now you had the big run that you're looking for. So that's one of those dangers. You look at your portfolio too frequently, and then oftentimes you just start getting that itchy finger and you want to mess with it, and you end up exiting what could have been a great trade.
Yeah, and it's really just it's the world we live in, man. People are focused on ultra short-term results. You talk to people and they'll say, "Oh, I'm a long-term investor. This is my retirement money. I'm going to be, investing in this for 10 years, 20 years, 30 years, whatever." And then they're looking at quarterly earnings reports and how much was the S&P 500 up last year, last month. And it's like 1 year is blink of an eye in an investing lifetime. And so I think it's important to decide like, and you don't have to choose one or the other on what I'm about to say, but you have to know what you're doing with the when you hit the buy button. Are you a momentum investor or trader, or are you a long-term buy and hold investor? And those two decisions, like for me, I separate those things into different accounts. I have an account that's specifically only geared toward momentum trades or speculations, as I like to call them. We won't get into the speculating versus investing debate here. We'll be here all day. But for me, that's how I separate in my mind is like when I click the buy button in my trading account, I if it's red, it's dead. I'm allergic to red in that account. I'm not going to watch something go down for, even an hour for the most part. If it's not going up, I don't want to be in it. I don't care. And I don't care about taxes and I don't care about turnover ratio. I don't care about how many trades I make. I just want to own stuff that's going up because it's going up. I don't care why. I don't do any fundamental analysis. I simply don't care. And it works fine. If I were to do the same thing in my long-term investment accounts, I would be blowing myself up all the time and probably would never make any money because I'd never give anything enough time to work, right? In order to be a good long-term investor who buys high-quality investments with good fundamental reasoning, you have to be able to click the buy button when nobody else is. That's the whole idea. That there's a reason that nobody else is clicking the buy button. That's why you get the good price. But then you have to be willing to hold it through some potentially some downside and certainly some sideways action for extended periods while you wait for the other people in the world who want nothing to do with that holding to realize that there is a catalyst and it gets back on their radar and they say, wow, this company's doing really well. It's growing revenue, it's growing free cash flow, it's growing profits, and it's really cheap. And you have to be patient enough to wait for that to happen in the market, and that's where your return's going to come from. Now, if I confuse those two strategies, right? If I trade the long-term buy and hold like it's momentum, I'm just going to be cutting my nose off every 5 days. It's gonna go nowhere, and then I'm going to be really upset about why my returns aren't better. But as long as I can keep them separate, and for me, that means keeping them in a separate account for my personal stuff. Um, but you can do it within the same account. You just have to keep track of why did you buy this thing? Did you buy it because it had momentum and it was going up? In which case, the moment that story changes, you better get out. But if you bought it because you think it's a good long-term business and you're just waiting for a catalyst for the market to realize that it's undervalued, then you have to be willing to hold it until that story changes, right? Which means following the company, listening to their earnings calls, reading their SEC filings, and making sure that what you thought about that business when you bought it, that it still holds true. And do you still believe that someday a catalyst will arrive that causes the market to realize what you realize, and then is when you will get your return? But that could, like in the case of XLE, you had to wait more than 3 years for that to happen on this recent run. So do you have the patience to be able to do that or not?
Yeah, that's a great point. How you talk about splitting between accounts or just some sort of separation because what happens is when you go and you say, I'm a long-term investor, but you look at it on a short-term basis, is it feels like you fought the 7-year war and it's been a year. So you're just tired, worn out. Why isn't something happening? And that usually creates the best hindsight trader in the world. They look back 5 years and they go, geez, if I would have just looked at the big time frame and just did something else, I would have done so well.
Yep.
But you get lost in the minutia and it gets really easy to just abandon your strategy.
All the biggest mistakes I've ever made investing in my life involves selling stocks, not buying them, selling them. And it's because I bought something that was a wonderful business that was going to compound capital at high rates for decades. And it, for whatever reason, went through some short-term pricing adjustments where the market didn't like it. The internal business was fine. It was doing exactly what it was supposed to do the whole time, but the price and the market dropped for some reason on some short-term basis, whether it was over a year. This thing was flat and the stock market was up 20%. I look at that and I'm like, what am I doing? I could have just bought the S&P 500 and been up 20% and I'll sell it looking for something else. And then lo and behold, 5 years later, I look back and that stock rose, hundreds of percent from where I sold it because I wasn't patient enough and I took my eye off the ball. So, man, I can't ever, all of the biggest mistakes I've ever made are that, exactly that.
I am in the same boat as you, unfortunately. That is
Yep.
the biggest one. And then I know we only have a few minutes left, but we can take that and just segue into this idea. So here it's February 20th, and there's a few key themes that I'm seeing here is are we now in a sector rotation environment? So we're moving out of the Mag 7. They're no longer leading, and that's over. And AI is that's still in emerging markets, which we've hit on that one. But I want to remind listeners again, we're a month and a half in. So short term versus long term. Any read through on that one, Shane? Sector rotation versus, is the Mag 7 dead?
Yeah, well, I wrote a bit about this in my commentary, which was a little short this month because it was way late getting out. For a few reasons, but I don't know. I don't think the Mag 7 is necessarily dead. I don't think the top 10 are dead. I don't like the Mag 7 as much as I like just the top 10 largest stocks in the S&P 500 for fundamental reasons that are related to passive investing. But what I will tell you is that the amount of capital that, especially the big four hyperscalers, Amazon, Alphabet, Meta, and Microsoft, the amount of money that they're spending building these data centers it's incomprehensible. Like the numbers are just absolutely crazy. And it, last year it was like highly correlated that the bigger the amount of capex you would announce, right? The more money you were announcing to spend, the higher your stock would go, which is totally stupid. And has it, like that is the inverse of what should happen. And I would say if you look back through the markets, the history of financial markets, that has never led to strong returns in the near term, right? Just massive outlays of capital, which are ultimately going to be depreciated on some schedule and are going to reduce your earnings per share for some number of years going forward. So, I mean, they're playing a dead chicken where they have to increase their revenue by so much and their gross profits by so much and their net margins by so much in order to overcome the massive depreciation that's going to hit them. It's let's just say it's not without risk, right? And I don't think if you look back through financial market history, you will find that massive capex like this was ever rewarded with strong, like, call it medium term returns, whether it was the telecom build out during the dot-com era, or I mean going all the way back to like building the railroads, right? Like it was obvious that railroads were going to be a new thing in our country, and they spent massive, massive amounts of money building out these railroads. And of course, the railroad stocks rallied for a time, but then as all that depreciation hit them, they absolutely got demolished. So it's hard for me to think that history won't repeat in some way. How far will they fall from where they are? Who knows? Will they ever? I don't know, but it does seem like the market's finally like getting a little bit of a I don't know, an allergy, to keep the same metaphor to the capex, like Oracle, right, is one of the hyperscalers I didn't mention, is down like 50% from its highs because it's not, it's borrowing money to do the build out. Like they don't have as much free cash flow as these other four to be able to kind of fund it out of pocket. So I don't know. As the market realizes that, it won't surprise me if there's kind of a ceiling on how much higher they can go from here. But the markets can stay irrational for a lot longer than you can stay solvent, as the saying goes. So we'll see.
Yeah, and I think I generally agree with you there. I think if you're looking at the Mag 7 top 10, um, they have just grown to a valuation that it's very hard to look at that and say long term this deserves an increased multiple from here or to go higher. But what certainly can happen is in a bull market, the melt up continues and they just get pushed higher for a little while. And the big thing there is knowing where you would get out so you can manage risk. But there certainly has to be that sector rotation. I think that's kind of the lifeblood of any bull market is there will be areas where there's better valuations, better opportunity. But I don't think right now going, oh, geez, we're a month and a half into the new year, top 10 haven't moved a whole lot, time to bail. It just naturally happens in markets where you have periods of rest before a rally happens again. So we'll see what happens. I think if I'm making a 5 to 10 year bet, I don't like the top 10 as much, but I think you can still see that push higher in the near term, not based on valuations, just based on money coming into the markets.
Yeah, and I think a constructive thing for the market overall is that it's really just a change in leadership, right? And people aren't abandoning these things. It's like what's leading now. And I mean, if I had told you, last year that the top 10 were flat to down for the first month of the year, where's the S&P 500? You would have said flat, you would have said down. I think you would have said down for sure because you would assumed all the other ones were falling. And even though, these leaders are no longer really leading the market higher, the market still really hasn't fallen. I mean, we're about flat for the year. So I think that's actually kind of productive, that the market hasn't absolutely crashed as these things have, stopped going higher.
Yeah, and that's exactly right. Oddly enough, I've got Nvidia pulled up on the chart, just looking at it, and quarter one last year sold off pretty good, and then almost doubled for the year. So just one of those big picture zoom out. It's going to take a break, and we'll see what happens, but it just isn't going to move up in a 45-degree angle the whole time.
Yep, you got it.
So perfect. Well, Shane, I know we're out of time here, but thanks again for jumping on, and hopefully Team USA pulls the gold medal in for the Olympics.
Yep, hopefully it looks like Canada just won against Finland, so looks like that's who we'd be set up to play if we continue winning as well. So go Team USA.
Yeah, Canada, that's a tough competitor. I think they're born with a hockey puck and a stick.
Yep, you got it.
So awesome. Well, you enjoy the rest of your day, and I'll see you next series.
Thanks, Kyle. See you, man.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.